Hey, if you've ever wondered how to put your money to work for both the planet and your pocket, then investing in solar energy might just be the opportunity you're looking for. Crowdfunding platforms today allow anyone, not just big banks or corporations, to invest directly in renewable energy projects. And when done right, this kind of impact investing doesn't just contribute to a greener and more energy independent Europe, it can also generate attractive financial returns. But let's be honest, not every impact investment is a guaranteed success. Choosing the right platform and the right projects is absolutely essential. That's why we've teamed up with Enerfip, one of Europe's largest and most experienced green energy investment platforms, to help you understand how to invest in solar projects successfully and, just as importantly, safely. Enerfip has been operating for over 10 years. As of March 2026, the platform has raised more than 810 million euros in funding across a wide range of renewable energy projects. Its track record is impressive, with total risk costs at just 0.1%. To put that into perspective, the average cost of risk in European banks is around 1%. This means that actual losses suffered by investors on Enerfip have been exceptionally low, a rare achievement in the world of project finance. Even more remarkable, the average net return after risk costs over the past 10 years stands at 6.4%. And beyond the financial performance, these investments have contributed to avoiding over 1 million tons of CO2 emissions, delivering real impact alongside consistent returns. We recently spoke with Enerfip's team to better understand how they evaluate solar energy projects, manage risk, and structure investments, so that you can make smarter decisions with your money. So let's dive into the essentials. First, we need to talk about risk. Investing in solar energy, like any form of investment, does carry risks. These can begin during the development stage of a project, where delays in permitting, land access, or grid connection can push things off schedule. Once construction begins, there are additional risks, from cost overruns and delays to the possibility of a contractor defaulting. Even after the project is up and running, operational issues like inconsistent sunlight, equipment malfunctions, or poor maintenance can reduce performance. There's also the question of who buys the electricity. If the revenue depends on volatile market prices or the buyer isn't financially strong, that adds another layer of uncertainty. Add to this changing regulations, counterparty reliability, and poor financial structuring, and you start to see why a strong risk assessment process is so important. So how does Enerfip manage these risks? It starts with deep due diligence. Every project on their platform undergoes thorough checks before it's even made available to investors. They confirm that the project has all the necessary permits, land rights, and grid access agreements in place. They also evaluate the track records of the developer, the construction contractor, and the long-term operations provider. It's about making sure that the people building and running the project know what they're doing. Contracts play a big role as well. Enerfip insists on having legally binding agreements for both construction and operations, with clear penalties if something goes wrong. And importantly, investor funds are released in stages. That means money isn't handed over all at once. Instead, it's dispersed gradually as specific milestones are achieved. For example, a portion of the funds might only be released once the building permit is granted or the grid connection agreement is signed. An independent technical advisor monitors construction and confirms that everything's on track before any final payments are made. But beyond the technical side, there's the financial analysis. Enerfip uses detailed financial models to stress test each project under a variety of scenarios. They look at revenues using both conservative and average solar production forecasts, and they apply realistic assumptions for insurance costs, equipment wear, and possible energy curtailments. Then they check key financial ratios, like the debt service coverage ratio and the loan life coverage ratio, to ensure the project can comfortably meet its financial obligations even if conditions aren't ideal. They also make sure that there are liquidity buffers, such as reserve accounts, and that investor protections are built into the legal covenants. Now let's talk about the worst case scenario. What happens if something goes wrong and a project defaults? Even then, the outlook isn't necessarily grim. Solar installations are tangible, income-generating assets, and even distressed projects can often be sold or refinanced. The Enerfip evaluates how enforceable the collateral is, things like pledges on shares or assets, and they study how long the recovery process typically takes in each jurisdiction. They also look at what similar distressed assets have sold for in recent transactions. And to be extra cautious, they often require a strong security package, such as a first demand guarantee from the parent company, along with legal control over the project's operating and revenue agreements. This gives investors a clear path to recover their money if things go sideways. All in all, what you get with a platform like Enerfip is a well-structured, professionally managed investment process that's designed to deliver steady returns while contributing to the energy transition. So whether you're passionate about climate action or simply looking for stable, long-term returns, investing in solar energy through platforms like the Enerfip can be a powerful way to make your money count. Huge thanks to Enerfip team for sharing these insights and helping us better understand the mechanics and the safeguards behind renewable energy investing. If you're curious to explore current opportunities, head over to Enerfip and see what they're offering. You'll find a wide variety of green energy projects across Europe, many with attractive returns. And this is just the beginning. We're continuing this series to bring you more practical, no-nonsense guidance on how to make your impact investments safer, easier, and more rewarding. So don't forget to follow crowdinform.com on LinkedIn and subscribe to our YouTube channel to stay updated on the latest opportunities in the green finance world. Thanks for watching. See you in the next episode.